Okay, hello everyone. My name is David. I'm going to give an update on the results I'm getting from my model at the moment. The last update I gave was in June, so that's 3 months ago. A lot has happened over the summer. I'll present what I've seen in the models over the last 3 months. I'm going to have to cut the presentation short, so I've got time for Cal at the end. So this will be about 15 minutes or so. Okay, this is where we were June last year. So I had a signal in the middle of last year, and it's a very reliable signal. It's happened 20 times in the past, 130 years of the Dow, and whenever that signal has happened, it usually leads to at least a 12% drop in the Dow, an average of 33%, and even the largest drop of 90%, which happened during the Great Depression. So it's a very reliable signal. This is the 21st time the signal had happened, and as we'll see, just recently the Dow has fallen 16%, so yet again it's surpassed the minimum of 12%, so a correction has happened following that signal. So having got that signal last year, I just built another model which came with 4 windows of opportunity for a top in the market. Window 1 was in July, 2 was October, November, 3 was end of year last year, and 4 was May to August this year, so over the end of the spring and the summer. When we got to December, it looked like we might have a top in window 3. It certainly had all the characteristics of the top. However, we still had window 4 ahead of us. As we move forward, there was a very large rally in February, and in March we had a new high. That meant that window 3 was not the top. And that left us with window 4. In order to break up window 4, because it's actually quite large, 4 months, I did some analysis on the daily chart. This is the weekly chart of the Dow. And I came up with 2 other windows on the daily chart, of A and B, so I superimposed those. And where B crosses over with 4 seemed a likely point for a top in the market. So as we move forward through April and then May, we see that the market came up at the beginning of May, at the May meeting, just at the beginning of where window B and window 4 coincide, and came down into June, and that was the presentation at the June meeting. And I believe that was actually the top in the market. It happened on May 19th. I'll give you some evidence as to why I think it was the top. The average after that signal for a top is 39 weeks. It's about 48 weeks to that top, so it was within the range that I'd expect. And the top was 18,351 in May, which was just inside the low end of that range which I'd given for the top back in June. Just looking at a much larger scale, this is now a quarterly chart, so each candlestick is 3 months. It covers 2007 to 2015. There's the top in 2007, and there's the low in 2009. Doesn't look so bad now, but that was the second worst drop in the history of the Dow. The worst was the Great Depression. This at 55% drop was the second worst in history, so that was a very significant drop we all lived through. If I superimpose momentum on the daily, weekly, monthly, and quarterly charts on this quarterly chart, these upward arrows show momentum upwards in the market and the price. But where the arrow ends, that momentum starts to weaken. And they're all weakening at the same point. So that's why I said around about end of Q2, about April, May, June, we may see a top in the market. The other thing I've looked at over the summer is the nature that we are at in the Dow Jones, the overbought situation. I've gone back through history. There's only one other time in history where we've seen the market so overbought, and that was in 1929, just before the Great Depression. I'm not saying the market's going to crash, because the market was in a bubble in 1929, and it crashed as a result of being in a bubble. The market is not in a bubble at the moment, it's very overbought, and mathematically, the price has to unwind in exactly the same way as it did in 1929, which means it's going to take 2 to 3 years to unwind. So I'm thinking, from the research I've done over the summer, that if we've seen a top in May, we're going to see 2 to 3 years of a downturn through to probably middle to end of 2017. If that drop doesn't happen now, it could happen a year or 2 from now. But since so many things are going wrong in the economy at the moment, my interpretation is it's going to happen now, which means we're going to see a low sometime, not next year, but the year after, middle to end of 2017. That's a long-range projection. Going back to the weekly chart, so I said back in June that we'd probably see a market top around about that time, and that May top could be it. Let's see what happened afterwards. So going forward through into August, and then here we are, current time now. We've seen the market come down, no, that's August rather, and then that now is current time, that's where we are now in October. We've seen a rally up, and as Darryl was saying, the current rally is a little broken. It hasn't got strong momentum. In fact, yesterday, the upward momentum on the daily chart was broken, even though we had a rally today. So I don't think the rally we're seeing at the moment is going to go much further. We may see a rally into year end, and a dip down before we see a rally into year end, but I don't think we're going to go any higher than the May top. And I think we're going to see a downturn into next year. The drop there, so there's the May for both the S&P 500 and the Dow. The Nasdaq actually topped out a couple of months later, not May, but actually in July. So it went a little higher. It took a little longer to get to the top. But that drop there was 16%. And if you remember what I said before, the signal I got in June last year always leads to at least a minimum of 12% in the market, so a correction. And it's actually at least so far 16% and probably more. The average for that signal is a 33% drop, so we may have more to come, and I believe we will have more to come in terms of downward moves in the market. The delay between the signal and the top, about 48 weeks, a little bit less than a year. As I said, not too far from the average of 39 weeks. Look at the Nasdaq. That rally over the last few years since the low in 2009, I said was long in the tooth. I said the characteristics means it wouldn't go much further. We had an all-time daily closing high and all-time intraday closing high on the composite, but since then we've seen the market come down. On the Nasdaq 100, same situation. The rally is weak at the top there and wouldn't last much longer. It didn't actually go any higher on the intraday or the daily closing high. They still belong back to 2000. But as we move forward to current times, we've seen a drop in the market. Treasury note, this is an interesting part. I want to try and explain why the Fed hasn't necessarily raised interest rates yet. This is a long-term view of the yield on the 10-year note. Goes way back to 1900, so it's a multi-year, multi-decade view. And you see in that red box, that's where the rates were very, very high in the 1980s. This is where we are now, at present time, the last 20 years. And we focus on those last, the most recent 20 years. This is a monthly chart of the rates on the 10-year. We see progressively lower lows down to 2012, where the low reached 1.4%. And a lot of people said at the time that's probably as low as it's going to go. I believe it'll go lower. And April last year, I presented some reasons why. And they were, if you look at the yearly chart, and this is, each candlestick is a year, you see from 2007 to 2014, we see a downward move, and this is a particular model that's developed by a well-known technician called Tom DeMark, and it measures momentum either upwards or downwards. Here it's showing a downward move in momentum. And the downward move phase 2 is always 9 candlesticks. Up to candlestick 8 was 2014, last year. And I predicted that potentially 2015 would be candlestick 9, but it would have to go below the close of 2011. And that would make the candlestick 9 the final point to end phase 2. Each candlestick must close below the candlestick 4 before, so it's 4 years before. And if that were the case, we would then see a possible double bottom or low and low in rates sometime this year. And we still may see that. That was my prediction. This was April last year that I did this chart. This is where we are now, so we're not far off. So candlestick 9 is hovering around about 2% on the yield, and it has to come a little lower by year end. So if the markets do deteriorate, if the stock markets do deteriorate, and money goes back into bonds, push yield, bond prices up and yields down, we could very well see candlestick 9 go below the close of candlestick 5, and then give us a double bottom or a lower low. I also think that probably we'll see a low next year as well, and that's my prediction for next year. We may see a candlestick go even lower into next year, and even lower yields. And that's probably one of the reasons why the Fed aren't increasing rates, because they realise that under huge pressure, that natural phenomenon effects are pushing rates down. And the last thing they need to do is increase rates at a time when rates are falling. So now looking very quickly at the quarterly chart, some of the analysis I did over the summer was looking at the quarterly chart, again, of the 10-year note yield. We have a phase 1, phase 2, the 9 candlesticks down from 2006 to beginning of 2009. That then yields the beginning of phase 3. Phase 3 is then 13 candlesticks. Again, this is the work by Tom DeMark. It's a very powerful model which depicts upwards and downward momentum. We got to candlestick 10, which was Q1 of this year. We still need to get to candlestick 13, because phase 3 usually keeps going and reaches candlestick 13. And each candlestick, to be counted as a number 1 to 10 or 1 to 13, has to close lower than the low 2 candlesticks before. So that means if we're at candlestick 10, beginning of this year, we get to candlestick 13, the minimum will be Q1, 2 and 3 next year have to all be lower, and even into the year after. So my prediction now is for that phase 3 to complete properly, it doesn't have to, but it's certainly a tendency that it does tend to complete. We're going to see lower lows into next year for the rates on the 10-year yield. Looking at 10-year yield, just a 3-year chart now. I had a low, a window opportunity, window 1, back in February, in the middle of this year. If we go through April, May, June, the market's bounced up, and then if we go August, and here we are in October, I have a potential window in Q1 of next year. So the interest rates will come up, they come back down again. And as I say, from the other evidence, I still think we'll see yields go down into next year. Currencies. Looking at a multi-year view of the dollar, just look at the last 2 years. I said way back in the spring that we had a big rally. It was probably going to end, but we may get a retest. What we actually saw, I think this was June, when the market came down, and I was expecting to see a bounce back up. What we actually have seen is the market's drifted sideways, but I'm still thinking we're going to see an increase again in the dollar, strength of the dollar, probably powered by money going into bonds if we do get a collapse in the stock market. As Darryl said, focusing on a multi-year view of the euro. The euro is a mirror image of the dollar. So looking at that, you see a mirror image. That's where we were in June, and I thought we were going to see a drop back down. This is where we actually are in October. I'm still expecting to see a drop in the euro as a mirror image to what's happening with the dollar. Looking at Apple stock, I'll wrap up quite quickly now. Looking at Apple stock, which I have done the last few months, but also this week Boeing and Home Depot. And next month I'm going to look at Amex, United Healthcare, Visa and Disney. These are all stocks within the Dow that are in a bubble. I've already covered Apple before, and I've written an article on it, and I'll show you some of the charts that I had in that article. I'm going to cover Boeing and Home Depot, but all of these stocks are actually in themselves in a bubble. But the Dow itself is not in a bubble, because there aren't enough stocks in the Dow that are in the bubble. You need to have the majority of the stocks to be in a bubble for the overall index to be in a bubble. Looking at Apple, huge bubble developed in 2012, and we've just seen this year. I had a particular algorithm giving me a score of 100%, told me that the bubble in Apple had probably reached the top, and it just went a little higher. I wrote an article, got published on the internet. I said that somewhere between the end of December and early February we'd see a top in the market. 5 days later that happened, so I was pretty close. Since then the market's drifted sideways. It looked like we had a double top in Apple. If we continue forward, the market's come down, so the stock has come down. We've actually seen a 32% drop in Apple. But the pattern I saw way back at the beginning of the year showed me that the Apple would not go any higher, even though the company's doing very well. There was going to be quite a serious drop. With a bubble, you'll always have a crash. If you have a bubble in a stock, or a bubble in an index, or a bubble in a currency, the model they have will always see a crash following, and that's what we've seen. And I don't think that Apple is fully deflated yet. I think it'll go further down, as is some of the other stocks. Very quickly looking at Boeing. They had a top similar time to Apple earlier in the year, and they've come down further. They've seen a 27% drop in their stock. But Boeing was in a bubble, and that bubble is deflating. Hasn't deflated fully yet. Home Depot, they've actually climbed up. They had a big spike down. They've climbed up. I think there'll be a high in the next few weeks, certainly between now and the end of the year, so the last 3 months of the year. And even that spike downwards was a drop of about 25%. So they've seen a significant drop, and I think that stock will retest those lows and go lower. I won't go any further because I want to leave a little bit of time for Kelly. I'll cover the rest of the commodities and global markets next month. But I'll end it there. Any questions from anyone before I hand over to Kelly?
Is there some way of following you?
Yes, I have a newsletter. And if you see me afterwards, I'll take your email address and I'll send you out the newsletter that I send out from time to time. And any article I get published as well, I send those out as part of the same distribution list.
Some of the lows you showed.
So it has to be louder.
Some of the lows you showed, like in Apple and Boeing, occurred on the opening of August 24th, and we're only there for a few minutes. Does that change your chart outlook? Because
No, because the mathematical models I use, they show a point where the stock will deflate fully, and they haven't deflated fully. They have to go lower. And I haven't shown China yet, but as Darryl said, China has not fully deflated. It has got to go at least another 1,000 or more points lower to fully deflate. And the one thing that I found is analysing bubbles is whatever bubble you come across, whether it be an index in a country, a stock, or a commodity, they all have to follow the same path. They have to fully deflate back to a point where the bubble started. And none of these bubbles are fully deflated yet. They've got a lot further. But the individual stocks I've covered here, China, I also cover Venezuela and Argentina. They're also in bubbles, and they have not fully deflated yet. You have a question?
I'm just wondering, like, out of all the stocks, why do you choose like Apple, Korea, and people you should review or something about like big stocks compared to others?
Well, they're all in a bubble, and that's a particular mathematical situation where you have exponential growth in price. And they're in the Dow. I've also got other stocks within Nasdaq and the S&P 500 I could cover. This is a lot of work to cover all of them, and I'll get to them one at a time. But I chose those particularly because they are all in a bubble, and they are all going to deflate a long way down. And I chose Apple first because I saw the pattern, and sure enough, it dropped 30%.
But I mean, the 30% is only for one day, and it goes down after that.
It'll go lower. I do believe Apple, all of them, because they have to deflate fully, and they have not deflated fully. It'll go up a little bit as people have hope, but that hope will be dashed. I truly believe that. There's a certain mathematical relationship, and that defines deflation, and they have not reached that relationship.